Hey everyone, welcome back to the Broker Life podcast. My name is Mark Panazon and I'm a mortgage broker with Mortgage Connection. I'm licensed in Alberta and British Columbia and have been doing mortgages for over 15 years. Today's guest is Tom Yeo, investment specialist and financial planner with Scotiabank. Welcome to the show, Tom.
Hello, Mark. Thank you for having me.
No problem. So let's get started with a couple introductory sort of questions. Why don't you just tell me how you sort of ended up in the financial sector and that's so Scotiabank.
Yeah, so I ended up sort of landing in banking somewhat by accident. Prior to this, I was a boat skipper and diving instructor in the Caribbean. And then I moved to Canada in 2010, which was the worst time to be moving and trying to pick up a career because there was still the fallout from 2008, 2009. But Alberta was the place to move to. Alberta was booming and still hiring. And then I sort of landed in a banking role. And I've been doing the same thing for 13 years now. Um, I've been in a variety of roles. I think when we first met, I was a financial advisor. And prior to that, I'd actually had a training role in a different bank. I've covered small business. I've been an assistant manager, but for the last 6 years, I've been with Scotiabank in this role. And it's one that I really love. Gives me a lot of independence, manage my own book of business and so on. Really what you want in banking and what most people don't get. So it's been a good ride and got a few more years in me yet.
And you and I worked at CIBC together for probably 4 or 5 years, maybe.
Yeah, I was with CIBC, I think, yeah, for 5 years total.
Yeah.
Jumped to the credit union briefly, and then actually I wasn't looking to move. I was approached more by Scotia, who were building out this role that filled a gap in the service. Most banks traditionally have a problem where well, they wouldn't see it as a problem, but they get clients who get a little bit too big for the branch to manage, but they're not big enough to move across to private investment counsel or the typical wealth management thing. So we fill that gap to help that transition and manage some of the higher value clients for the branch, where they'll need a little bit more in the way of financial planning. They may be looking at what does their retirement actually look like, and the branch just really isn't equipped to help them answer those sorts of questions. So say we help with that, and then finding them investment solutions that sort of bridge the gap. So if they grow bigger, we can transition them off to wealth proper. And if not, we can manage them throughout their retirement and how they draw down the funds and make them last.
Let's dig a little deeper into that. So, investment specialist and financial planner, it's a mouthful. What is it exactly that you do for clients, and who exactly are your clients?
So my clients will typically have between $100,000 and $1.5 million in investable assets. And primarily, I'm a financial planner. So I'm probably jumping ahead a little bit here. What that involves is sitting down with people multiple times and having a conversation. And the first conversation is definitely not around money. It's around what do you want to be able to do? Because money is a means to an end. We will look at your situation, try and define your goals, because a lot of people won't necessarily have even thought about this. I saw a brilliant quote recently, and it was, everyone knows what they want to retire from, but they don't really know what they want to retire to. And it's trying to get people to sit down and think about that a little bit. But then there's also the goals in the meantime, educating your kids, maybe some big trips that you want to do, those sorts of things. And I would also say that there's things that people haven't considered as well. So a traditional plan that involved retirement would be very linear. It would be sitting down with someone who says, how much money do you need each month to retire on or each year? And then it's pretty much flat all the way through. And that's not the case. I think we understand now that there are phases through retirement. Your first 10 years or so, your expenses could even go up. You're doing all the fun stuff that you wanted to do. You're doing the travel. You may be a snowbird. And then it settles down a little bit into the middle phase. And the end phase, you might actually see expenses go up again because then we've got a budget for things like additional medical expenses or some sort of assisted living, those kind of things. So our plans are actually quite in depth, and we can also model different scenarios for people, which I think they find very valuable because they can then ask the question, so if I were to do this, what would that look like? And we can run the two side by side and multiple scenarios as well. So it's really helping people to visualize what they want to be able to do. Once we've got the plan in place, then we move into the next step, which is finding the investments that will actually work for them.
That's interesting. So minimum 100,000 up to around a million. And you said investable assets. So what is an investable asset?
Basically cash in the bank. It could be investments that are somewhere else. It could be that group RSP that they've got somewhere. what we're looking at is to try and help them bring all of that together, not just in one place necessarily, because the plan is longer term, but ultimately it's to bring it under that umbrella and manage everything together. A good example of something like that would be, so we have a lot of people who work for energy companies, and they'll receive share options as part of their package. They'll tend to have quite a bit invested, but it will be tied up very much in a single energy stock, which is not a smart way to invest if you were picking your investments from the start. Absolutely, you should take them if it's free money, but we need to look at that holistically and say you need to be disciplined about how you spread that around and try and diversify, or we build a portfolio that's complementary to that, and takes into account the fact they're already heavily exposed to one particular sector. What can we do to mitigate that and find things that are not correlated?
This topic of diversification interests me immensely because as someone who manages their own investment portfolio through a self-directed brokerage, I know nothing. Let's be honest. I grew up in the banking world, but it would do me a lot of service for someone like you to help me, put it that way. But I take pride in it, and I'm closely linked to it with the mortgage end of things, and I do try and follow the economy. And I always say I'm sort of a student of economics. I'm learning as I go, but probably to my detriment. This idea of diversifying your portfolio and having the right amount of, say, bonds to equities to cash, is this a model that is something sort of you can sort of set it and forget it, or is it much more complicated, unique to each individual's plan, as you sort of alluded to?
A bit of both. Investing is a long-term game, and I think a lot of people don't understand that. Now, yes, you could make money as a day trader, but you need to put an awful lot of time in, and there's still no guarantee you're going to make money at it, even if you're actively involved in it. Ideally, we'd like to set up something that is a longer term solution for people and then adjust as we go. But there is no one size fits all. It is very unique to the individual, and everyone should have some sort of customization because the plans are all going to be different. There are certain off the shelf solutions we can use that will cover sort of a broad range of things. But some people will come to me and say, I don't want to overpay on fees. I'm looking for a low cost solution. And that's going to look very different to the person who says, I want to be completely hands off. I don't look at my statements. I don't care what happens. I just want to have money in the end. There's a running joke that, the best investor is a dead investor. But it's absolutely true where when we're settling estates and things that take multiple years, you'll find out if the investments have just been left to run. But quite often they've made a huge amount of money in them because no one's watching it, and it just does what it's supposed to do. The ones who tend to lose out are the people who are reacting to short-term news. They're actually very difficult to work with because you're constantly trying to coach these people through times when the news is bad. And really, you should be putting more money in. And then when everything's going great, they now have money that they want to invest. You're saying, well, honestly, it's a little bit expensive at the moment. You really want to get everyone on what we call a dollar cost averaging plan, where they're just putting a regular amount in and kind of forgetting about it.
And obviously time horizon is probably really important too. If someone's starting in their 20s versus their 50s, the plan probably looks vastly different.
Yeah, absolutely. I think a lot of people will find when they start out, obviously they go into a bank, they meet with an advisor, but there's a lot of inconsistencies there. So if you meet with someone, let's say, who's not licensed to sell funds, by default, you'll end up with a GIC. And then every few years, you'll get a call from the bank saying your GIC is matured. Do you want to renew it? They don't typically get that conversation about maybe there's other things that you could be invested in. You should be sitting down at least once a year and reviewing things like time horizons and risk tolerance, and especially when there's life events, because things do change. And I don't think that's done enough. You also see that, say, with group plans that people have through work, where when you're onboarded, you fill in a questionnaire, and there's never any prompts for you to go back and revisit that questionnaire and look at how you're investing again. So it's assumed that what you answered back 10 years ago has persisted right the way through, and that's not reality.
That's interesting. Would you say that you have your own investment philosophy, or is that too simple?
Somewhat. I mean, it's adaptable enough to different people and what they require, but again, it comes back to being long-term, diversifying. Now, I do favor active management, not necessarily for the entire portfolio, but I do believe that certain good managers will not necessarily beat the market per se, but manage the volatility better. If it were really simple, everyone would just dump money into an index fund that replicates the broad index and just leave it. But there are always ways to leverage things. And what people find out is they're not ready to ride that roller coaster necessarily. You talk the talk, but when you're actually in the thick of it and your investment portfolios drop 30%, things look very different. There's a lot of psychology involved. I would favor the managers who look for the picks and shovels. And what I mean by that is during the gold rush, lots of people headed out to the area around San Francisco, California, looking for gold. Most of them didn't make any money. But the people who did make money are the people who sold them their picks and shovels. So if you've got the managers who are looking for those sorts of companies, and we can see this happening at the moment where AI is booming, it's a buzzword. It's the managers who are looking for, okay, AI may not be the way to make money at the moment, but who are the companies that can service all of this buzz and still make money from it? And quite often it's being very patient. It's buying them up a year or two ahead of time, maybe even 5 years ahead of time, and then just holding and waiting until everybody else catches on that, hey, this company actually, there's a bottleneck in the supply chain here, and they sit right there at that point. They're the only ones who can make money from this. Those are the managers I would favor.
That's a good story. I like that analogy. I want to get into AI in a bit here because I do have some questions around that and technology in general. But let's circle back to the actual financial plan. Can you walk me through I don't want to say typical plan because obviously these are highly unique, but let's say for someone like myself who's about 40 years old, got a young family, and let's say we're starting out around the minimum, a couple 100,000 or something like that. What would it look like? And you don't have to go into great detail. I imagine it takes a lot of time to build these, but high level view of what that kind of looks like.
So the initial conversation says it's going to be more personal. It's going to start with family. Who's in your immediate family? Are your parents still around? Are they close by? Because it makes it seem like a sort of meaningless question, but a lot of people are now retiring and looking after aging parents. And that's not something we ever planned for. And if they don't have those support networks in place, who is looking after them? We look at occupation. How steady is the income that you have? And what's the sort of standard of living that you've reached? And do you want that to continue in retirement effectively? Are you going to change jobs? Are you going to immediately retire? Or are you going to keep your hands on something, do something part-time, whatever that may be? And then it's, what do you do for fun? And how long is that going to continue for? And in an ideal world, what would you really like to be doing with your retirement? Because if we can make that happen, fantastic. If we can't, you need to start adjusting. You've still got a good 20 years plus probably before you retire. You've got time to make some changes if you need to. And then we get into the monetary things. And firstly, what causes people stress in managing their money? And if they're looking at their statements, does it worry them? Because we can't do something that will make somebody uncomfortable. It's going to be counterproductive. So there have to be some sort of compromises usually there. We will look at total net worth. So that will include things like your principal residence and additional properties that you have. And the software will actually calculate in things like capital gains and so on. So if we want to say sell off a rental property partway through, it can do the calculations and make the deduction value there, and we can direct that money to wherever it may be needed. We look at the estate at the end of the day and also year by year. So we can calculate net value of an estate if someone were to pass away. And that will flag things like, do you need to adjust your will because you've got accounts here that we can't put a beneficiary on, or do we need to update beneficiaries? Do we need to make things joint? Because there's pros and cons to that sort of thing. And then ultimately there'll be recommendations that come with what we've seen from the numbers, because the numbers don't lie. And realistically, if I were to say there's a typical plan for someone in their 40s, we will have projection at the moment that doesn't fully fund retirement. And then we'll have an alternative that says, these are the things you would need to do to make it to retirement. And they may not all be practical. And that's not really the point. but it's to show how much you would have to sacrifice to get there. Now, income goes up over time, kids leave the home and so on. You may get better than expected returns on your investments. So, it may swing back in your favor a little bit. And this is why you have to then revisit it, because it's like a GPS. It just says, this is how you get from A to B. This is one way to do it. Life gets in the way, you go off route, we can bring it back on track. And it gives you something that's measurable that you can look at and say, am I still on track for this plan? Or have we deviated further? What do we need to change?
I like that. So a couple of points I want to touch on there. The first one is, it sounds like you're sort of almost formulating a budget. You're trying to understand your costs now, what your future costs are, and then just different buckets of where you spend your money or where your money goes, maybe.
Yep.
Okay. And then the estate part of it. So do you do estate planning and deal with wills and things like that? Tax planning as well? Is that part of your role?
So tax planning, no, that was specifically not allowed to give tax advice. But that being said, to be successful in my role, you have to have an understanding of tax and its implications. And again, the plan will throw up areas where there's going to be issues. And the advice then is you need to talk to an accountant, because it has to be a CPA who gives tax advice. Okay. Also, the benefit actually for having a plan, and especially when we're looking at business owners, people like that, is, if you talk to an accountant, their job really is to save you as much tax now as they can and go year by year. And it's not that accountants are dumb people. If you present them with a plan and say, but this is what I want to be able to achieve, they can adjust. So it may be a matter of drawing more income from your corporation year by year. So you make CPP contributions and you can put money into RSPs if needed. And then that sort of integrates as well with the lawyer as well, because we can obviously identify where there will be legal issues. The main one is most, or too many people, let's say, don't have a will. They really should. Probably more important than the will is the power of attorney. Because if you get hit by a bus tomorrow and end up in hospital for a few months, somebody needs to be able to manage your finances for you. And if you haven't thought about that or put that in place, I have seen cases where the money's tied up because the main breadwinner just had a sole checking account and nobody else can access that money to pay bills.
That's terrifying. And that probably fits into the category as well as insurance and life insurance, right?
Yep. Actually, I'm meeting with someone who you will know from CIBC days. I'm going to have lunch with her today, who's still in insurance. So that's Lara.
Oh, good. Oh, good.
Yep.
Yeah. That's interesting stuff. Okay. So when you're analyzing, or I guess, how do you analyze and select investments for your clients? You mentioned software earlier in the chat there. Is it sort of an algorithm that figures out based on the criteria you're inserting what it is, or are you more involved in the process?
Definitely more involved for the process. I'm a very heavy user of a program called Morningstar, which can rank all of it's a third-party site. You can look at all the investments available in North America, pretty much, and run apples to apples comparisons between them. Obviously, I have some go-tos that I'll typically use to build a full portfolio around. It may be as simple as someone just wants a single solution. And then we can look at things like private investment pools that we can put them in where they're managed within the pool and all the rebalancing occurs within there. Other people are happy to be hands-on and that'll lower their costs, but then we need to meet frequently if we're going to have to rebalance a portfolio that's got several different things in it, different functional areas. And occasionally people will come and ask for things that don't necessarily exist. Like yesterday, I had someone saying they want just dividend paying stocks, but they want tech stocks. Those two are normally mutually exclusive. Dividend companies have surplus cash, and that's why they're paying out their dividends to their investors. Tech companies burn through cash like crazy, don't tend to have a surplus, tend to have more debt. So some of that's just trying to reconcile things that don't quite fit together and make sure we've got a decent solution for people.
Gotcha. So your involvement, the value of Tom Yeo is really highly unique, and your advice and your product selection could be vastly different from any other Scotia advisor, let alone any other advisor or financial planner like in Canada. Really, it's a unique Tom Yeo feel on it.
Yeah, I guess so. I mean, there's only so many investments available. If we're honest, if you go to one bank, you go to Scotiabank, RBC, TD, and you buy their standard portfolios, they're going to be broadly the same
Fairly
investments
similar.
because there's
Okay.
a limited supply that's available. What we can do is tweak things if someone really wants it that heavily tailored. Most people don't, if I'm honest. I say 80% of my clients really just want something that's going to work and manage the volatility. And I think what we've seen out of the last couple of years, 2020, we had a big drop. Last year was a bigger drop, but more steady on the decline, is that can create stress for people. And I think my main job through those periods is to coach people through, and that's probably where my value comes, is explaining what is going on, giving people the economic insight, because if they understand what's happening and why, and we have obviously I can't predict the future, but we can give a reasonable timeline on how long we expect this to last, people are then more comfortable sitting tight. As you say, you manage your own investments. It can be pretty much a grit your teeth time when everything's dropping and you're wondering, should I be getting out of this and buying something else or sitting on the sidelines? And the problem when you're trying to do that is you have to be right twice. You may get out at the top of the market. You've also got to be ready to get back in at the bottom when the news is overwhelmingly bad. And everything you're reading is saying this is going to go on forever or the whole system's broken. It's never going to recover. It does. And that's coming back to it being a long-term game and trying to keep people focused on the end. That's
the psychology part of it, right?
Yeah.
What's the old saying? Buy low, sell high. That whole philosophy is simple in like the idea, but incredibly hard to actually execute.
Yeah, I think the better one to follow would be Warren Buffett, where he says the market's driven by fear and greed. If everyone else is fearful, get greedy. If everyone's greedy, get fearful. That tends to work quite well.
I've heard that one as well. Let's talk about risk. So risk in general. What are your thoughts on risk and how do you manage it for your clients? You kind of mentioned a little bit that some clients are more high maintenance, let's just say it, whether freaking out at the slightest drop of any marker. How do you manage that for those clients? And then for the clients who don't care and just say, I just want to see a big lump sum at the end of 25 years. How do you manage that sort of behind the scenes? And I guess the question I'm trying to really get at is, are you actively making trades on each of these portfolios to adjust the balance based on the market conditions? Or are you having that discipline, just letting things sort of ride? You have the plan, stick with the plan.
Very much the latter. Timing the markets is setting yourself up for failure, because by the time I've got the news or anyone else has the news, you're at least 15 minutes too late to react. You can't react to what's going on now in the news. You do have to look more holistically. Now we can look at broader trends in things. To give you a for instance there, we just went through very rapid interest rate hikes last year, and that knocked bonds down like we really haven't seen. So the expectation would be bonds would now be a safer bet if you're going to invest than they were just over a year ago. And looking into that, when I was doing plans, I can go back and see what I did previously. I was using higher rates for inflation to sort of accommodate the fact that coming out of the pandemic, I suspected this was going to happen, as did many of my colleagues. Now we're adjusting that back down again, and inflation is not coming down quite as fast as the Bank of Canada would like, but it is coming down. So we can use a lower rate now if we're looking ahead. It's the best investors say, and you said the ones who are hands off, just say, let it ride. They're easy to manage. Risk means different things to different people. Most people, it's going to be the volatility on their account. But if you look at someone like a GIC investor who's saying, well, I'm laughing because my account didn't drop in value. In fact, I made a guaranteed return. You may well have lost out due to inflation anyway. You just don't see it in dollar terms because you're not equating the cost of living now with what it was when you put the money into that GIC. If we went back nearly 2 years ago, the best investment you could have got in hindsight was a 5-year GIC at probably just under 1%. Or you pick the 2-year GIC at 0.8. That would have been your best investment through that particular time period. But hindsight's 2020 and things are roaring back. The markets aren't broken. They still work the way they're meant to. So I think there's unseen risks. GICs have a liquidity risk as well associated, which people don't see. You get the same thing with real estate. People buy real estate as an investment. They don't factor in the liquidity of it. If you need to sell a property, You have to sell it in whatever the market is like at the time that you need to sell it, if you need to access that cash, and you have to sell it all in one go, which means there's probably a capital gain, maybe a capital loss, but that capital gain has to be taken all in that year as well. So I would encourage anyone who's looking at investing in real estate, by all means, do so. It helps diversify your portfolio, and if you have the money to do it, get in there, but do look at the risk involved. Because let's say you need a rental income to survive on that and make the payments against the mortgage, you need to factor in what happens if your tenant's out. The place floods and you're not getting rental income for 3 months, 6 months. What does that actually look like? Can you get through that? So it does need to be looked at beforehand. It's not sort of an impulse purchase, which I think a lot of people do. They find an opportunity, they jump on it, and then they end up thinking about it later. And some find it's a big headache.
And certainly the costs associated with purchasing real estate are extreme when you're talking about bank penalties, real estate fees, legal fees. I mean, it's not really that easy just to get in and out. If someone's looking to get into the real estate market, is there alternative investments outside of actually buying physical real estate?
Oh yeah, absolutely. There's I work a lot with Dynamic. They have a real estate fund, which it does. I think it's specializing at the moment more in multifamily residential stuff. They will have things like cell towers in there, will fall under real estate, because obviously people are not getting rid of their phones anytime soon. Even if we head into recession, they'll still be paying their phone bills probably. Yeah. That gives you the advantage that there is more liquidity, and you can get into areas that would be very difficult to access just as an individual investor without going through some of these private equity firms and some of those REITs that you get.
So I guess one of the big differences between those sort of investment funds is the dollar amount. So if you're going to buy a home, you're in the hundreds of thousands most likely. If you buy in a REIT, or you could put in $1,000 and that's your exposure. Yeah, exactly.
I mean, we don't touch them, but there's things like mortgage investment corporations as well, who will be your B lenders on the other side. They have a very glossy, shiny page that shows how you can get a really great return on your investment. But then, of course, they're charging mortgage rates that will be above what you can get from a bank because they're higher risk loans on the other side.
That's right. Yeah. Great to have them, though. They come in handy.
Oh, yeah. They do fulfill a purpose. So, yeah, they belong in the marketplace.
Let's talk about your fees. Now, do you charge fees directly to your clients? Is it a fee only or commission-based model, or how do you earn a living, and how do the fees work with the clients?
So mine are a portion of the management expense that's built into the funds. And typically that will work up to $750 to $1 million. Then you want to switch probably to a model where there's now a standalone fee and a lower cost for the funds that you have. So that's why we fit in that sort of niche there. In dollar terms, you'll pay less, probably up to about, say, the 750,000 mark by doing it that way. So yeah, we don't charge to buy or sell the funds. We don't have a standalone fee or anything like that.
So it's part of the MER, the management expense ratio?
That's right.
So if a fund has a 2% fee on it, you earn a portion of that fee?
Yeah.
And then when do you collect that fee?
It just goes into my account.
When you purchase the fund?
Oh, okay. So the MER is built in, and that's just a standard fee that you'll pay as long as you hold that fund. And the returns that you see on a fund will be net of that particular fee. So I'm deriving my income from that, basically. It doesn't change based on the type of investment that I put somebody into. So there's no incentive for me to pick one particular fund over another or anything like that. I can be impartial in the investments that I pick. So, if they're a conservative investor, they're not going to be forced into something that's higher risk because I get paid more for it. That doesn't exist.
And so are you paid only commission?
I get a base salary, which covers more or less the financial planning aspect of it, but it's fairly small in banking terms. And then, the bulk of what I make is commission. And most of that comes now from a trailer. So that's from looking after the clients that I have. So there's an incentive there to actually make sure that I am keeping that contact up. And I am doing the updated reviews for people, because otherwise they can just go somewhere else. Part of the job also is making sure that I'm available. It's really frustrating trying to get a hold of your bank if you need something sometimes. and it's a direct number to me, and I get questions about all sorts of things, and I can be that point of contact for people. So if it is a mortgage question, they'll likely call me first, and then I can put them in front of the best qualified person to help them with what it is that they need.
So let's try and put a numeric value on this, just so people understand what's costing them. So if somebody has a $100,000 portfolio versus $1 million, is there a number that you can put down and say they'll pay roughly this amount to have this?
Not really. I mean, so we're talking about the management expense. So I will usually try and keep it below 2%. I can put together customized portfolios around the 1.5% mark. So, on $1 million, you're looking at 15,000 to 20,000 if you were to break it out. And that will actually show up on the statements as well for people, but they're not paying it out of pocket. So they get their returns net of that. Once you get up, as say, into sort of Scotia McLeod territory, would be our wealth management company. They could charge anywhere, say, 5,000 to 7,000 maybe as a standalone fee, and then you'll pay half that amount on the funds that you have there. So down around the 1% mark usually.
And when those funds are then eventually withdrawn via RSP RIF or just bulk withdrawal or something, that's when they're deducted from the.
Oh, no, it's an ongoing thing. So they don't have any penalties or fees to pay. There's no deferred sales charges or anything like that. So you can get into a fund as long as you stay in it for a month. You can switch and move to something else. That doesn't cost anything. We can do that for people. So it's a lot more flexible, I think, than, say, I'm not going to pick on individual companies, but some of the insurance companies would sell things with a deferred sales charge on it. And it was pitched as a benefit that you can buy this investment. We're not going to charge you to get into it, but if you move over the next 7 years, you'll get a penalty on the back end for switching. And that would start quite often at 7%, and it wouldn't disappear until it was 1% in year 7. And then they could move it. But it does kind of lock you into an investment that may not necessarily be good for you.
No kidding. Okay, got it. Now let's talk about your competition. So let's first start with the self-brokerage models. I'm at CIBC still, and I got the what's it called? The Investor's Edge account.
Yep.
And I've never really left it. I opened it more than 10 years ago. And it was just for fun at the beginning, a few $1,000 just to play around, buy some marijuana stocks or something. And then I left CIBC, and then I ended up getting my locked-in retirement account, and then I decided to put it in there. So there's a good chunk of money in there from the Lira. And then I said, I think I'm up to the task, and I've been wrong. I was doing well for a while when the market was doing well. I was doing well, and really basic principles for me: index funds, really low risk, diversified across almost every industry. I was doing well, but then sort of COVID hit, and then panic ensued, the psychology of it and stuff. So I think I know the answer to this question. It's pretty simple, but what's the main difference between having an active manager like yourself or the sort of the self brokerage or self models where clients are just managing their own finances?
I would encourage everyone, my clients, to have a self-directed account. No, I actually enjoy it when my clients have self-directed accounts, because I think they gain an appreciation for how hard it can actually be and how much effort you have to put in. When I was at CIBC, I opened the Investor's Edge account, and I thought, I'm licensed. I know about the markets. I can do this. So I'd actually actively trade in the morning and in the evening. And I did make money. And then after a few months, I sat down and looked at how much I'd made, and it basically came out to about $7 an hour.
Yeah.
This isn't worth my time,
Yeah.
It's like anything in life. Like, I can do basic plumbing. I could probably do some fairly complex plumbing with the help of YouTube. But if a pipe bursts in my house, I'm calling a plumber, because they're the expert. They can get it fixed and go on their merry way in an hour, and it just takes the headache away from me. Obviously, what I do is a lot more impartial. So I would say, give the bulk of what you got to someone who's just going to find you something that's high quality and give you a call when they think there's maybe some risk involved or you should make some changes. And then you can play around with, 10, 20% and make those mistakes. But, I can't discount the fact that people can make money doing this. I looked at my portfolio the other day and worked out that through COVID and last year, I'm actually up about 40% gross over those 3 years. But that's just a couple of lucky calls. Really, Shopify and Nvidia are two companies I bought several years ago before they got big. And that's really all that's driven my portfolio. There's a few with some positive returns that are not that great, some funds that are positive, but I've got plenty of dogs in there that I shouldn't have touched. And these ones are just offsetting that. To give you an idea of what is difficult or where the danger lies with index investing, if you looked at the S&P 500 this year, you've got 500 companies there. It depends which news article you look at, but it's about 20 companies have driven the positive returns so far this year. I think we're up about 12% today on the S&P 500. If you took those 20 companies away, it would be down just over 1%. So there are 480 companies there that aren't doing anything. And that's a problem with index investing, because you've now got this index that's skewed where those 20 companies make up about 29% of that investment. And that's problematic. And they're actually trying to change that, I believe, where they're sort of splitting things off or spinning things off, because that's a risk, again, that people aren't accounting for in their portfolio. If you were building one from scratch and you didn't have the option of that index, would you put 29% into those companies? Or would you put a smaller amount in there because they do move a lot and they are quite volatile? So, it's easy investing and it's lazy investing to index, but it can be very, very worrying when you've got so much risk in one area that swings very, very far in both directions.
That's really interesting. It reminds me of a Warren Buffett quote, back to Warren Buffett, where I think he said something like, you only need, I don't know what the number was, but it was under 20, maybe 10 good stocks in your lifetime. And that will be enough for you to set yourself up. But the challenge is picking those right 10 stocks. You got two of them. And of course,
and he did a lot of reading. Now, the funny thing is Warren Buffett now advises everyone to go for index funds. And that's what he said he wanted done with his estate, to manage it for his wife. It should go into index funds. But that is not what he does, not what he ever has done. And in fact, his holding periods have been quite short for some of his investments too, despite the fact he's considered to be a long-term investor. So it's very much a do what I say, not what I do kind of thing. He's also acknowledged, though, it would be very difficult to do what he did now, because there aren't big enough acquisitions for him to drive the same returns that he did when Berkshire Hathaway was a smaller company. But also becomes some sort of self-fulfilling prophecy. If Warren Buffett buys something, everyone else piles in and up the price goes.
Totally.
So you can't really go wrong at this point if you're him.
Yeah. Wow, that's good stuff. Now, one other part to this is there's the actively managed portfolios, there's the self-brokerage portfolios, and then I want to throw in a third category, and I don't know if this exists or not, but back to AI. So
robo-advising.
Yeah. And, I've seen a ton of ads on this. Instagram's just has got a number of different ads where, you have a client that shows up and says, oh, I just put my money into this machine. It figured out the algorithm and it makes trades for me and I'm up $1 million or whatever. How realistic is it? And obviously there's a future for AI. We can't stop that. How do you see that being implemented into your business, your industry?
It's probably coming whether we like it or not. Is there still space for the human interaction? Yeah, absolutely there is. Because some people will still prefer to talk to a person who understands them and understands the emotions involved. I think AI is all about trying to take the emotion out of it. Whereas that's great on paper, that's not the reality. People are emotional. And you have to be able to talk to them about that. If I type in to an AI that I'm getting scared about this, it may try and give me something that's comforting, but it's going to be a very formulaic thing, and it won't know necessarily what's worrying me.
Wouldn't that be the benefit, is to have a computer that's not emotional, that can control the psychology and say, no, this is the algorithm, this is what the market does, don't move. Obviously, it's not going to comfort you.
That's the problem, isn't it? It's the comfort level that comes from it, and it's giving you the same advice it's giving to everybody else. And once everybody is doing exactly the same thing, where do you find your advantage? And if the market starts going down, it hurts everybody the same way. There's always room for people who are actively managing and trading stocks, because there's always going to be someone who thinks they've identified something that beats the market. There's a few other things about this. So a few years back, when I first got on with Scotia, I got to talk to she was the chief investment officer at the time. And I asked her about algorithms and how AI is affecting the industry, because you'd expect it to become more rational, or I did anyway, and that things would sort of be a bit more even because it's machines making judgments and they all should be fairly consistent. She said, no, it's just increased volatility because you've got all these competing algorithms feeding off each other and they can react so quickly. It's very hard now to sort of keep up with what's going on. And as a human making decisions, you wouldn't be able to do that on a short-term basis. The machine has already beaten you to it. And this is why people are building closer and closer to exchanges just so they can get that, millisecond faster response time there. AI, it solves some problems and it creates a lot more, I think, is the issue there. I have held an ETF called, it's an AI-based one. It's run by Watson, AIEQ, I think it is. It hasn't really done anything outstanding. And I think you've got to understand that these are still programmed by people at the start. What you don't know is how they're going to run. If you've got AI that's trying to adapt, you end up with these problems where occasionally it'll do something irrational and it's like flipping a switch, and then various other algorithms feed off that, and you can get these odd little runs on the market. They have to shut down trading on a particular stock for 15 minutes while they reset everything and try and get it back. So a lot of it comes down to how well programmed these things are. I mean, ultimately, I guess an AI could suddenly beat the market, and that would be a problem when it starts buying everything up because it's found a way to arbitrage things.
That's interesting. So basically what I'm hearing is they're still programmed by humans and humans make mistakes. And if the algorithm is incorrect, you're going to have errors until the AI is smart enough to learn about those mistakes and then start actually thinking for itself, which again creates another set of problems where now everybody's making money, everybody's losing money at the same time. And who are the winners and losers? There's really only market balance now because there is winners and losers. Now, you could argue that it's not great and you'd want everybody to make money, but
it really comes down to what a human thinks something is worth at the moment. That's how stocks move and that's how bonds move and are valued. It's what am I willing to pay for this based on where I'm betting things are going in the future.
That's so true. Yeah. Okay, good. Let's wrap that one up. I want to get into some actual stats here. So I've cherry picked 4 or 5 stats here, and I would love to get your opinion about where you think we are, where we're going, sort of more macro sort of views. So let's get some obvious ones out of the way. Inflation peaked at around 8% over the past couple of years. And I looked back on the chart. We haven't been that high since about 1983, year after I was born. So roughly 40 years of lower inflation, or at least not this high. And now we're at 8%. Causes for inflation can be widely speculated, but my view on this is perhaps one-sided, but I feel like it's very related to government spending and devaluing the dollar. So the more dollars in circulation via printing money, generally that means higher inflation. Are you in the same sort of thought as that, or what's your kind of rationale why inflation is so high?
Yeah, so you'd have to go back to 2020 to see why we're in the predicament that we're in. We went into a pandemic and there was a lockdown and people had to stay home. And a lot of people couldn't go to work and they were basically paid to stay home. And that's overtly printing money. My personal opinion is that maybe it went on a couple of months too long, but it was essential. People had to survive, had to be able to pay their bills. The other thing which is not so obvious is Bank of Canada and other central banks buying up bonds. Now, the bond market is huge compared to the equity market. And they'll step in and they will shore that up. So what they did by buying huge numbers of bonds is they restricted supply and thereby kept prices stable. That is also printing money. So they can take that money out of the market, but they have to wait for those bonds to mature. And that could be 5, 10, even 30 years till they can actually remove that money by getting the principal back at the end. Now, we also had that compounded by supply chain problems. And you have people sitting at home actually with surplus cash. So let's say you're sitting at home and you think your TV's a bit small and you want to get a bigger TV. There weren't any to be had. So if Best Buy suddenly got one down the road, you're not going to wait for a sale. You're just going to go there and buy it for whatever they're asking. And that's how inflation manifests for most people. And you see it in food as well. Food went up a lot. Farmers aren't being paid anymore, but there's price being added all along the chain, and energy costs being higher impact that as well. So the central bank did what it had to do, but you then have to pay the price for that. So we've now got, you say, inflation peaking around 8%, down to about 4.4 at the moment, I think. It's not coming down as fast as they would like, but the only tool they really have to combat that is to raise interest rates and make it more expensive to borrow and try and give people an incentive to save money. And they may have pushed that a little bit far here, but so far the labor market is strong enough that we've not seen mass defaults on mortgages, which is the problem we could have. Now, if that continues, and fingers crossed it does, we may get a technical recession where we get negative growth, but without layoffs, and that would be good if we can get that. If
Soft
not,
landing.
if not, we start seeing layoffs and we start seeing mortgage defaults. Banks have already set aside loan loss provisions and increased them. So when you see the banks announcing they've made a loss for the last quarter, it may not actually be that they've lost money. It may just be they've taken a pool of money off the books and set it aside for loans going bad. And then if that doesn't happen, if you look ahead, you'll actually have some quarters where profits are better because now they're bringing that money back on the books. It's the same money. Nothing's changed. People still react to it, though, in the short term where banks lost money or their earnings fell short. They sell off the bank, the share price goes down. It'll bounce back again when they bring it back on.
That's interesting, and I totally agree with all that. So let's go back to the bonds. So the balance sheet has been growing, and that was quantitative easing or tightening?
Quantitative easing is when they're buying, tightening is when they're not buying. Or
so easing, so they were buying bonds. Okay, so the balance sheet was growing. They were printing money in addition to that. So they were printing money, and then they were, with that money, then buying bonds, which was growing the balance sheet. And then the bond yield goes down, right? Because the return is lower.
Right, temporarily, yes. Now,
temporarily,
and
then now
flip happen.
Yeah, go ahead. So why don't you speak to the bond yield? So the stat I have here is just that it hasn't been this high since 2008. And then what I've learned, with my limited knowledge of the economy here, is that the bond yields and fixed rates are in unison. So when they go up, fixed rates go up and vice versa. So can you speak to that a little bit?
I think the simplest way to address that is how bonds function. So a bond is debt. You're lending money to somebody which they can use for a bit, and they will give you a guaranteed interest rate, paid on a consistent basis until they're done using that money, and they'll give you your principal back. And that's the yield of the coupon that you get from that bond. Now, let's say I give someone $1,000 in a 4% market. Okay, I'm getting $40 every year for lending them that $1,000. Now we raise interest rates. We push interest rates up to 5%. I decide I actually need that money, so I want to sell my bond. I put it out there on the marketplace asking for $1,000. Nobody's going to buy it because now they can get a bond that pays them $50 a year. Why do they want to buy my bond that only pays them $40 for $1,000? Doesn't mean my bond is worthless. I have to drop the price on it. So I need to make it look like they're getting the yield that they expect. Now, very simply, I could drop the price to $800, and that $40 yield every year is what they want, and I could sell it quite easily. But it's still worth $1,000 at maturity. So now there's a formula to work out how long is it until it matures, and we can bump up the price a little bit to account for the fact that they'll get $1,000 back at maturity. Does that make sense? So when we get hikes like we had last year, back to back, 4.5% or so, that knocks down current bond values a lot because the market is demanding higher yields now. And all the bonds that are issued at lower yields aren't as valuable in the marketplace. So last year was a terrible time for bonds and equities as well. It's the worst we've seen since at least the 1950s and possibly all time, because equities and bonds aren't typically correlated. But when they both go down together, that's, I think, only the fourth time since 1954, something like that.
Right.
And it was by far the most extreme. That has an impact again on mortgages, as you'll be aware. So your fixed rate mortgages are based off bond yields and trying to forecast, looking ahead a few years, what the market's pricing those at. We did have something called an inversion in the yield curve as well, which is where you're not being as rewarded as much for longer term as shorter term. And that's because people are trying to get short term as possible and bidding up the price, basically. That I hope is sorting itself out now. But that's problematic because it goes against the rules of risk and return, where if you're giving someone your money for longer, you expect a higher return. You shouldn't be getting a higher return on something that's shorter.
Yeah, and this is what's been so complicated this past couple of years, that inversion of equities and bonds. Typically, if the equities go down, that's the time to buy bonds. That's the safe space, simplistically. But they were both going down.
So I think it's a bit of a misconception. It's usually pitched as equities and bonds move in opposite directions, and they don't. It's just that the correlation isn't that strong. So they move independently of each other. So if one is down, it doesn't guarantee that the other is down. And this was just one of those years where planets aligned and they both dropped together, just because of the circumstances that we were in. And you can look back and you can analyze everything and understand exactly why it happened. Trying to predict it when you're looking ahead is quite a lot harder.
Okay, got it. The overnight policy rate has changed or hasn't been this high since 2001. So that is, as you mentioned, how the only tool that the Bank of Canada has to fight inflation. I think the only tool. So inflation ticked up last month. I think it was 10 basis points up. So then after, what was it, 8 consecutive hikes last year, the bank paused. And now they've hiked again, 2 days ago, another 0.25%. So this is impacting variable rates, adjustable rate mortgages, HELOCs, auto loans probably as well. How does this impact the investment world, or does it not impact the investment world outside of the fact that this is tied to inflation?
It absolutely does affect us. You can pick certain areas. So generally the shift is more towards value, which is trying to find companies that are undervalued and you're getting a good deal on them, and a swing away from growth. Because growth companies basically need to borrow money to grow. And also when you raise interest rates, you have to discount their future cash flow. So that money is not worth as much in the future in a higher rate environment as it was when it was a lower rate environment.
Gotcha.
And that'll swing around, and then growth investors are looking for deals at the moment and buying those companies that they expect to grow over the next few years. And that will swing back. But growth would not have performed very well over the past year if you're looking at it in isolation. And then it sort of falls out of favor with investors as well.
So is it easy enough to say when interest rates are high, that's more of a time to go value stocks versus growth stocks, and then inversely the opposite?
When they're going up, yeah. I think now we're probably at the peak. I was actually one of the 60-40 split between whether they were going to hike 0.25% or not. 60% saying they wouldn't, 40% said they would. I was on the 40% side. I figured the Bank of Canada was going to crack the whip one more time, and they could do it yet again, one more. And I think what you have to understand is that you'd have to look back at the 1980s to understand why they're being this aggressive. Because we had prime go up to 22.75%, and you had mortgages at 20%. That was bad enough then, and they don't want a repeat of that happening. So they've hiked rates very quickly, because now the spread between the cost of a home and incomes is much, much wider. So when you increase someone's mortgage payment, it's a lot bigger. We've seen variable mortgage payments more than double. They've extended amortizations, I understand, up to say 60 years in Toronto in some cases, just to keep people paying their mortgages if they can. If we hit 20% again in this environment, the defaults would be absolutely horrific, and it would destroy the economy.
Oh man, what a nightmare. This is a good segue. So the next stat is household debt to income. It's at 180%. This is just fuel on the fire. We already have high rates. We don't want to go back to the 70s and 80s where you mentioned the 20% rates. I remember stories of people just going to the bank and handing their keys over saying, we can't do it. Just take my home. I like to follow a lot of the C-SPAN political debates and just watching basically Polyev and Trudeau go back and forth. It's entertaining. It's pointless at times, but it's entertaining. Why can't Canadians get ahead in this regard? Is this a political issue? Is this a more broadly global issue with like supply and demand? Like, why are we spending so much more than we're earning? Are we not making enough, or just we're truly just spending so much because we're printing so much?
I think partly it's a cultural issue. to be honest. You could probably solve a lot of this with proper education, but I know there are programs to try and get into schools and teach people about this, but it's not interesting when you're a teenager. We could do a much better job of just trying to educate people on an ongoing basis, I think. Homes here, compared to what I'm used to coming from the UK, are huge. I live in a house that's easily twice the size of what I could afford in the UK. We've come to accept that this is the standard of living. I'm sure you deal with this. You must have people coming to you as first-time home buyers who are expecting their dream home as their first home. We have a shortage of properties in Canada. We know that, and that's now again pushing house prices up. We really should be looking more at building some smaller homes, I think, which are more affordable for people and encouraging people not to overextend themselves. Mm-hmm. And part of this, and I'm somewhat sympathetic, but the 2 years leading up to last year, I think 52% of the mortgages that were taken were variable rates. And that was people trying to qualify for the biggest mortgage they could to get the biggest, best house they could. Mm-hmm. And Bank of Canada, though, was saying we don't foresee raising rates anytime in the near future. I usually take variable mortgages, but for the first time in my life, about 2.5 years ago, I took a fixed rate mortgage because just out of interest, I pulled up the Bank of Canada's mortgage rates, which go back to the 70s. And I noticed that fixed rates only dipped below 5% and stayed there in 2009. Like they'd explored that area before, but they'd never stayed below. So in the grand scheme of things, fixed rates a couple of years ago were extremely low. And I said to myself, I can afford the fixed rate this time. There's not much spread between 2 point something and 0, but there's an awful lot of room above. So maybe it's not the time to be greedy with this. And I locked in for the first time in my life.
Well done.
Yeah, I mean but that level of education and knowledge isn't necessarily available to most people. And being that dispassionate when you're looking at it, it would have been very easy to take a variable mortgage then, with a spread below prime. Which would have been really low. And I could have increased my payments, I guess, and got ahead a little bit. But I'm patting myself on the back now because I've got another 2.5 years of a really low rate. So,
well done for you. Yeah. And, as a professional selling mortgages every day, we have the same information available to us. And when the bank says rates are going to be low for a very long time, I'll admit I was telling people, yep, there's little chance that the rate will go up. This is a 1% interest rate. It's a once in a lifetime opportunity. But you're right, all of the risk is to go up. So you have a rate slightly higher on a fixed. And I would say it was about split. I wouldn't say there was an overflow for me in 2021 of people saying definitely variable. I think there was a lot of caution and at least some thought as to maybe the fixed rate does make sense. And boy, for all those people that selected variable, and I feel absolutely guilty for saying, it's a good deal, proceed. It's their decision at the end of the day. But when you're getting information from people who are much smarter than me, and then they're wrong, that seems to be a problem. I mean, that's if the managers of the money are not managing the money responsibly, they got to go. And so, yeah, I agree with the education piece, certainly, but how much money we spent during the pandemic was probably a little too much. What I often wonder is what happens if they spent no money? What would have happened if, relatively like no money, like, help out the absolute necessities, but like no cutting checks to, the CERB checks or whatever, like this, no extra help at all. What would have actually happened? Would businesses would have closed? I would imagine people lost jobs.
I mean, this has caused an ongoing problem too. If you looked at the CEBA loans, that was a lifeline for companies. Like they needed that money if they're not able to sell their products. So you'll grab at whatever you can. But now they've got to pay that back. And they've not necessarily returned to the same cash flow that they had before. And now businesses are struggling to pay back that loan
at high rates.
So they're not really better off. All they did was kick the can down the road. If you're looking at things completely dispassionately, some recessions can be seen to be a good thing because it just cuts out all the good businesses and so on that really aren't viable, and then new businesses that can grow come out and move to the fore. So in that crucible, you get advancement in things. But we are also talking about people's lives and their incomes, and you can't discount that when you're making decisions, especially if you're a politician. got to look after people. We didn't know what was going to happen in 2020. We hadn't had a pandemic in 100 years. The reactions were not well thought out necessarily. It was just a matter of get the money out and get it out now. Yeah. And some people definitely needed that. Others didn't. What's interesting to me is that the tax-free savings account came out in 2009, and that was in response to the fact that people did not have enough in savings going into 2008. And the government was looking at what could we do to help people out and give them an incentive. So the TFSA was it. And a lot of people did use it, and a lot of people did have money going into that lockdown. Where it gets tricky is, does someone who has enough in savings disqualify themselves from a government benefit that someone who wasn't prudent enough to save is entitled to, because they've both lost their jobs? How do you make that decision? You basically have to cut a check for both of them, but understanding that one of them doesn't really need that money. And then other people got the money even though they didn't necessarily qualify for it either. So the means testing part wasn't necessarily there. I mean, it's really difficult. We can look back and criticize. Would we have done anything different? I mean, if it happens again in a few years, we'll have learned some lessons, hopefully. Not repeat it, but definitely it's a problem that we've got so much money sloshing around out there.
Yeah, and you're right. Hindsight's 2020, and it's easy to criticize the Trudeau government. I'm guilty for that. Do they deserve it? We'll see. I think there's some other mistakes they
I can criticize any government.
Frankly, yeah. I mean, it's less of a political thing, more of a human sort of what was the right thing to do. And then the levels is interesting. There's a good meme or clip out there. A reporter asking Trudeau about the spending and saying, how are we going to service this debt in the future? And then Trudeau says, Glenn, interest rates are at 1% all-time lows. Like, that just shows you that they'd never had the foresight that by printing all this excess money that it's someone's got to pay it back. Now we're dealing with that. So money supply, M2 is at 2.42 trillion. I want to ask you about alternative investment vehicles. And we don't have to spend too long on this, and we're getting bumped up on the hour here, but I'm just curious, what are your thoughts on Bitcoin? What are your thoughts on cryptos? Is this something you actively are having conversations with? Do you have access to these investments? Or is this still pure speculation and you avoid it at all costs?
So we don't offer it as an investment, and I probably get asked every week about it. Eventually we will get in there. Now, if you talk to our portfolio managers about why we don't get involved in crypto, is they will say it hasn't had its Google moment yet, and that may be coming. What that means is if you go back to sort of the infancy of the internet, you had all these different search engines. Yahoo's still around, but you'd have Lycos and AltaVista and all these sorts of things. And then Google came along and just completely changed the playing field. And that's kind of what has to happen in crypto, because there's a lot of problems that haven't been solved yet. For instance, they would say that they can rival credit cards. Well, Visa and MasterCard do so well because they have this payment system that is incredibly efficient. If you have an open ledger, let's say you carry out a transaction with a value of $10, and that has to be recorded on every computer that's attached to that network. Just the energy consumption alone is more than the value of the transaction that it's recording. And people would get fed up very quickly if they're paying for everybody's transactions to be recorded and they're not doing any themselves. That's just a very basic example of one issue that's there with it. It's also not being treated as a currency. It is being treated more as a commodity. And in fact, I think the SEC is challenging Coinbase and one of the other exchanges on what the nature of their business is. I don't think they're being malicious about it. I think it's actually more of a legal test case kind of thing to see what the determination is. If people were treating it as a currency, then it does need some sort of government oversight. And that's what people don't want, because that's counterproductive to what they want to use it for, I guess. You need that stability there. So you've got to have that confidence. And you've got to understand the greater fool theory, something is only worth what the next person is willing to pay for it. And if you're the bag holder at the end of that chain and there's no one left to sell something to, at that point it's worthless. That's very much the way this is going at the moment. Have I dabbled a little bit? Managed to come out ahead, but I don't know how long that will last, because it's pure speculation, I think, at the moment.
Okay, good. I just wanted to get your take on that. And I do agree. I think that it's early. And, I think the argument for Bitcoin is that it was the first one. It's got the biggest market cap. But Google wasn't the first one.
No,
Yahoo
and
probably wasn't the first one.
Bitcoin has this sort of evangelical following where people buy it because it's Bitcoin, but for no other reason than that. And I'm pretty sure now there will be better currencies out there. But because Bitcoin's the first, obviously that's the one everyone knows about.
Yeah. Yeah. Let's just see how that goes. Last couple ones for you. How would you view this current economic cycle that we're in right now? Whereabouts are we in the cycle, based on your view? Is there light at the end of the tunnel? Are we still headed for recession? Are we in a recession? We're not, I don't think, in a technical recession yet because GDP is still, we're still in the positive. Can you share something positive in this regard?
So, is it light at the end of the tunnel or an oncoming train?
Yeah, exactly.
It's really hard to tell. And to be honest, we don't tend to get into that with clients. If the time to invest is when you have money, that's the best time, even if the market's about to drop, because if you wait long enough, it will swing back up and you'll have money in the market when everyone else is worried about it. So that's really the way to go. Now, as far as interest rates, I think they really have run out of room. They can't push them any higher. There's a very good chance we do see a recession in the latter half of this year at this point. Could it be a small one? I really hope it is. If we can say keep it at the labor market tight as it is, we're okay. We'll get through it fine. I don't see a 2008 style crash at the moment, but what do I know? It could happen. We didn't see rates going up as fast as they did. We knew they were going to go up, just not at this sort of pace. Does this avert things? I don't know. There's so many counter arguments to everything. Like house prices really should be plummeting at the moment, but they're not. They're moving in the opposite direction, which means that there are still people qualified and willing to buy those properties. We're not building enough houses in Canada. We've got so much immigration at the moment. We don't have places to put everybody. That can also help to keep things buoyant as well, because you're adding more people to the economy coming in ready to work. And most immigrants do come in with their own financial means and they're self-sufficient. They're not coming in to live off government handouts. So honestly, the Canadian economy looks okay at the moment, but I think we kind of need a recession. As unfortunate as that sounds, we need to hit that sort of reset button and then things can look a lot rosier. I will also say, though, yesterday it was announced that the S&P is in a technical bull market since October of last year. So we're back in a bull cycle again, and they last an average of 5 years, I believe.
My goodness. So we've hit the bottom, at least in the S&P 500. So maybe a good time to buy.
Well, October would have been the bottom. That was the time. The market builds up, and it's like a pressure cooker. You get this pressure builds up. Now, 2020 led off quite a bit of that steam. 2022 let off a bit of that steam as well. So there's definitely room for things to continue growing. It would just be nice to see it spread out over more than just 20 AI involved companies and see some growth in some other areas.
Yeah, totally. Yeah. And the disruptors of any, coming out of the recession will be interesting are these AI companies going to be this new, this new energy that fuels the next sort of bull run, or is it the same old, FANG?
That seems to be it. Like Nvidia, I think, was the biggest jump that's ever been seen for a listed company in one single day. I'd have to look at what it was. It was over 20%, I think. Yeah. That's really unusual, but all of the news you see about it says it's justified because people are just buying up their chips like crazy and they're having trouble keeping up with the demand. So they anticipate selling more over the next quarter. If that continues, that's great. I'm still waiting for this future, though, where robots do everything and we just harvest the money, because it doesn't really seem that way. You still only get paid for the work that you do, even if a robot does take some of your workload.
It's coming. Tesla looks pretty interesting right now with what they're doing as well. That'll be interesting. Now, last question before we get into the speed round, which is this bonus fun part to end the call with. What is one or some tips you can provide someone just looking to build some wealth? Very basic.
Set aside a consistent dollar amount bi-weekly or monthly, and just stick to it and forget that it's there. Treat it like another bill, because if your cell phone bill went up by $100 a month, you'd probably still pay it. So you can afford to pay yourself $100 a month.
Lovely. Dollar cost averaging.
Yep, absolutely.
Yeah. Okay, great. This last section of the podcast is something I do with all my guests. It's called the speed round, or this or that. A little more laid back, a little off topic. Folks can get to know you a little bit on a deeper level.
All right.
What I plan to do is sort of post a funny sort of video at the end of the year with all the different responses, and just see if there's any correlations with some of these responses. So about 9 questions for you. You ready to go?
Okay.
Okay. First one, house or condo?
House.
Fixed or variable?
Well, fixed at the moment, usually variable long term.
Coffee or tea?
Coffee, absolutely.
Even a guy from UK, huh?
I got into coffee during the pandemic. That was my new hobby. So I make espresso. It's ridiculously expensive.
Lift weights or run?
Neither. I prefer swimming. But if I'm forced to, run.
I think it's got to be 5 or 6 guests in the row that are just like neither. Next. Yeah. Morning or evening?
Morning. I crash about 3 o'clock in the afternoon. I'm not very productive after that.
BMW or Mercedes?
Mercedes.
What's your favorite pastime or hobby?
At the moment is running around after my kids, but I'm coaching rugby and really enjoying that at the moment. So I'd probably say that.
Oh, that's fun. What kind of music are you listening to these days? Any genres or bands or?
It's a really good question. I'm getting back into lots of the weird stuff from the 80s. Just the brilliance of the YouTube algorithm that'll pop these things up now and again. So I'm going down a rabbit hole of revisiting stuff I've not listened to in decades.
Any band you care to mention?
Oh dear, no, I'd probably be embarrassed. You know, things like your Durans will pop up, and then that'll lead you into all sorts of other stuff. Thompson Twins.
Good, thank you for that. And the last one is, what's the last book you read?
Black Swan. I've got to think who it was who wrote it. Was it Taleb?
What's that about?
It's a good one, especially for the investing world, because it sort of turns everything on its head that we would typically say to our clients. But it's about these one-off events that happen that you can't necessarily predict for, but theoretically you could plan for. Some really interesting stuff, especially as it applies to the investing world, because 2008 was one of those events. And he's saying these black swans do tend to happen again and again.
Interesting. Black swan events. Was COVID a black swan event? Probably, right?
Yeah, I suppose that would probably qualify, although we've had pandemics in the past, and if we're smart, we would plan for the next one ahead of time and learn lessons now. Problem is we don't. I mean, you see it even in the financial markets where, was it Sarbanes-Oxley, was it? It was the banking measures that came out in response to 2008 were then rolled back. And that's why we had this problem with these banks in the US going under, was because the regulations they said were unfair to them because they were smaller banks and not systemically important. So they rolled back these regulations and then they mismanaged their risk and end up going under and having to be bailed out effectively because of it. Silly stuff like that. So I'm not very sympathetic to Signature Bank and Silicon Valley Bank. They should have known better.
Totally. Absolutely agree. Tom, this has been super insightful. I appreciate your time. Where can people find you?
Probably through you is the best place. Yeah. You can search me up on the investment specialist site on Scotiabank if you're looking in the area west of Edmonton. So I cover everything now, Spruce Grove, Stony Plain, all the way out through almost Jasper. I was in Hinton yesterday, Edson. But I'm mobile and I can do a lot of things remotely as well. So if someone's in Alberta, I'm happy to help them out.
So best to Google your name and Scotiabank, Tom Yu, Scotiabank.
Absolutely. Yeah. Or as they get in touch with you, you've got my contact info.
Wonderful. Well, thanks again for doing this, Tom.
You're very welcome. It was great. I'll do it again anytime.